On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and my partner, Tobin Smith, is away on assignment today. However, he should be back by early next week as we have a long list of great guests that are joining us. But today I have a fabulous guest, Erin Gibbs. She's the Chief Equity Strategist at SlateStone Wealth in Florida. Erin, welcome back to Buy, Hold, Sell.
Thank you. I'm happy to be here.
Absolutely.
Happy from beautiful Jupiter, Florida.
You're down in Jupiter, Florida. You made a big power move. You left New York. You went to Florida, joined a fantastic firm, and you look happy. You sound happy. It sounds like things are really working out well for you.
Yeah, I'm happier than I ever expected. And my friends in New York keep telling me how happy I look. So
that's great. That's great
I'm like,
news.
Be part of the migration, guys.
Yeah, it does seem that way. A lot of people are headed south. But I know one thing that isn't heading south, and that's the stock market right now. We touched on record highs today in the S&P after the producer price index came in a lot softer than expected, fueling more jubilation that next week's Fed meeting, we are definitely going to be seeing rate cuts. And of course, we have tomorrow's consumer price index, which is the headline number that everybody will be talking about. But it doesn't seem like there's going to be a lot of movement there that's going to take the Fed off the ball of cutting rates. But you have an interesting thought on how bullish this is once the Fed does cut rates. Can you explain?
Yes. So I think it's important when we look at how rate cuts affect different equities. One of the things is that it's a really good time to get into small caps right about when the Fed has cut rates by about 200 basis points. And so we're already at 100 right now. And obviously we're looking at 25 or 50 in the next 4 months. Mm-hmm. And so we analyzed over the past about 40 years, there have been 7 instances where the Fed has cut rates by 200 basis points. Mm-hmm. And at 6 out of those 7 instances, small caps outperformed large caps by an average of about 10% over the next 6 months. So if you're thinking about repositioning your portfolio, this is absolutely a time to think about getting into small caps, even though they have been horribly underperforming, and this is largely just because of the higher Fed rates. But as we're getting cut, really think about repositioning and getting into small caps, because this is absolutely the time that you do want to think about getting back in.
Genius approach. I got to say, I've never heard this before, but it does make a lot of sense. And I'm sure when you look at his just history with talking to other experts like yourself, like the Stock Traders Almanac, I'm sure they probably have data points like this too to support this. So when an investor is, or an audience, our audience is listening to this right now, and when they hear this, and you're talking about small caps, are you talking about a small cap mutual fund, ETFs, or individual equities?
So all of the above, and actually I should say, I preface it, it's really SMIDs. It's your small and your mids. They really trade in tandem. When you look at the different benchmarks and indices, they pretty much have very similar returns with similar volatility. So you can do either just index funds. One of the reasons I started at SlateStone is actually to start a SMID fund, hence why I'm so aware of when things go well for them. So certainly, individual stocks as well, but across the board, when I'm looking at outperformance and what I just said, that 6 out of 7 times in the Fed, that includes the mid cap benchmarks as well as the small cap benchmarks.
Yeah, you bring up a good point. And you are talking about also with the next 4 meetings, which is what the Fed has left this year, the consensus overall is looking at least 2 cuts in those final 4 meetings. So I have a question for you then. What happens if the Fed continues with this type of easing policy into 2026? Does this further accelerate that growth in the small and mid cap area?
I would say the one thing that would be dependent is, are they accelerating it because we see a real problem with the economy? And so that would be the big caveat of, well, that might push that acceleration of small caps until people feel confident again, because obviously small caps are very sensitive to rates, but they're also very sensitive to sentiment. And so if people are feeling very conservative and risk off, we're not going to see that huge outperformance until people start feeling confident again. So if we're seeing the rate cuts where they keep coming in, and yet we're still seeing, relatively strong performance, we're still seeing very good earnings, which we've been seeing within the market this year, and what we're looking at for forecasts for the next 4 quarters. I think that would be a great setup to still get into those small caps.
Okay, that makes sense. So,
Yep.
what is your forecast though with the Fed? I mean, is this going to be, because there's a lot of drama, as you know. You
Yeah.
have the Lisa Cook story that's going on. It looks like she is going to be able to vote because a court actually recognized saying that her firing was illegal, but whatever. And now she is able to vote. But however, going forward, it looks like that seat will become available. Do you see that the current administration is kind of placing the pieces of the puzzle here to make this a very easy or easing friendly Fed, at least going into 2028? Or do you think it's still going to try to remain that independent structure?
I think they are going to become accommodative, but they have always had an influence, or have been influenced rather, not haven't had an influence, but they've always been influenced. And I think at the time has really swung the other direction, and they need to listen. And so I think for this next cut, I'm going with the typical bets that 75% people were, the surveys say it's going to be 25 bips, not 50. I think they should just do 50 and get it over with, because that's what we're all expecting for the year. So
Yeah.
why drag this out? But that's me. That's my
Yeah.
opinion.
Yeah. The data dependency, that's
Yeah, which as we find out, some of the data is highly flawed. So why not just cut the rates by 50 basis points? But, I'm a little more pragmatic and not a PhD. So there you go.
Speaking of though, I assume you're alluding to the BLS revisions. What's your take on that? Because 911,000, that difference, you're talking about 75,000 less jobs that were originally reported. And Wall Street, I mean, the first Friday of every month, it's literally Christmas morning. I mean, for Wall Street traders and investors, they're focused on that number. Do you feel that this has to be buttoned up, because that data integrity is so important? I mean, what are your thoughts?
Yeah, I do think that has to be buttoned up. And I think this really reflects what a lot of people have been saying and feeling. That they didn't feel that the economy was as strong as it was. You hear about young people struggling to find their first jobs, and it's taking them months and months and months. And so I think this really validates what a lot of people have been saying, is that it isn't that easy to find a job, and it is taking them longer. And we're seeing a lot of support now. Admittedly, that the economy is changing, because we do have gig economies and part-time workers, and that sort of clouds some of the numbers. But absolutely, if they're only getting a 48 or a 40% response rate, of course it's not great data. So either figure out a way to make it easier for companies to respond or get a response, motivate them, but do something, because if like only 40% of the people are responding, yeah, it's useless.
That's a good point. So you touched on the economy, the weakness in the economy, and we see the flight to safety with gold. Gold
Yeah.
touching it hit a record high. It actually withdrew a little bit this afternoon. But what's your feeling on gold? Do you feel that that's an area that investors can focus on?
I do. I only because for me, the main catalyst for gold would be the weakening of the dollar. And as long as we have inflationary concerns, as long as we have fiscal budget concerns, even with, the whether, how these tariffs end up playing out, as long as the dollar is weak, gold is going to do well. And gold is going to do well also while we still have inflationary concerns. So I don't think that trend has completely played out. I think there's still some time for it to run up. And certainly in this period, it's a good diversification tool, against when you have real returns from your bonds becoming smaller and smaller as we cut rates, as the bond yields come down, but we still have this inflation. you might as well have gold to protect yourself from that inflationary environment. And so I think that could be quite some time where we could see gold still being, a solid portion for inflation protection.
So it still has some legs then. So
Yeah,
that does
I
make
don't think
sense.
it's over by any means now.
What are your thoughts with now that we're talking about interest rate cuts, and which you would assume that would bring the 10-year yield down and then therefore mortgage rates lower, that would stimulate real estate. Is this an area now that you're down in Florida, I'd imagine real estate is doing quite well there.
Yes.
But do you think that's an area for the rest of the country where investors could start paying attention to?
That's the tough one. We really haven't seen interest rates or the mortgage rates to come down because the 10-year has remained so stable.
It's been
And
stubborn.
and it's been very stubborn. And so that's again about fears about sticky inflation,
Mm.
fears about the budget deficit, the quality of, just how the US government is run. And until those fears go away, I don't think we're going to see those rates really come down. I think we're only going to see the yield curve steepen where we get lower rates on the shorter end. But as long as that 10-year is sticky, we're not going to see that ability to have lower mortgage rates and then more, price affordability when it comes to first time home buyers.
Okay.
So
Yeah. Well, I like that. It's a good point. Let's turn the page here because I love talking to you about the health of the American consumer. And then we start getting into a conversation about retail, which then turns into luxury retail. But right now, just on a macro level, from the health of the consumer, of the American consumer, we see debt levels rising. But do you still see the consumer? Do you feel that going into 26? They're still going to remain as robust as they have been?
I believe so. I think while, we may see some shifts away from certain products into others and, certain people, others winners and obviously people with more competitive advantage, the consumer is going to be strong. We haven't seen, while we've seen, a slowing hiring, we haven't seen layoffs. So, we may not have had as many jobs, but we're not seeing a full recession where people are really going to cut back on their purchasing power. And so I think that's going to be where the US consumer still loves to spend. And they are going to continue until a real fear takes over.
So would you be a buyer of some of the retail companies that are out there?
Very selective. I mean, apparel is tough. It's very hit or miss. Gap stores are great, but there's some like absolute disasters out there. I really like brands that again have a very specific story. This is staples consumer, but I like Celsius
Okay.
drinks, the energy drinks.
Hmm.
They've just bought a bunch of different brands that also diversify to healthy protein shakes for, more directed towards just females rather than just more male consumers. So I think there are pockets in the discretionary that are always doing well. I know we have the Ozempic effect that's been negative for some of the snack food players.
Right.
Um,
Yeah.
but for Celsius, it's actually the opposite end because it's nice and high protein, very healthy. So there you go. As everybody's slimming down, those are the companies that'll be doing well. But I do think, yeah, just being very selective. I think that's where stock picking is the most important, and it's not about simply buying the sector.
So I'm going to throw a retail name out for you. American Eagle. Now, American Eagle had an amazing quarter. They
Yeah.
reported just blockbuster numbers, and they credit actually their growth and their success on the Sydney Sweeney campaign. Now, Sydney Sweeney has a birthday coming up on Friday. I would imagine everybody's going to be bringing up American Eagle, which would be probably a bullish catalyst, at least in the short term from a trading perspective. Is that a company though, because of her and that marketing, and it's gotten so much, would you think of going long American Eagle, or you think that's something you should just stay away from?
Well, I think it's partially her, but we've also seen a few stores like American Eagle that were very focused on 90s styles that have been doing well all year. So Gap really picked up with the denim trend and the denim 90s sort of baggy style. Oh, sorry, and I'm blanking. There's one other. I should know my fashion lines. But there have been a few stores that really did focus on 90 trends early on, got that trend right, and have been doing very well. And again, this is what I'm saying about consumer discretionary is it's really about picking the right stock and getting the right company versus just buying the whole sector. So I think as long as that 90 trend, which as far as I can tell is still going strong, I think American Eagle, along having Americans, I mean, you probably got another 3 months, at least another 3 months, like at least another quarter until a good, another report.
Wow,
Yeah,
that's good.
they've
That's
just
very,
really been able to constantly hit the trends and get it right.
yeah, it does seem that way. And plus obviously the marketability has
Yeah.
just been phenomenal. Let's talk about the big box retailers quickly. On Target, they have a new CEO. However, they promote it from within. So Wall Street felt it was just going to be the same old story where they were going to continue with inventory concerns and just a lackluster culture for the company. It's completely shifted. Out of Walmart and Target, which one's your favorite?
I'd probably go with Walmart. Though I
Yeah,
actually shop at Target, but
yeah,
as a company, I'll go with Walmart.
yeah.
They're just better run. So
And I'd imagine probably part of that reasoning is the grocery side. It seems like they do quite
absolutely.
well on the grocery
I mean,
side.
it's a great way to get people in the store and you get all of your shopping done in one set. And so, yeah, it's just very strong. I mean, Walmart is the single biggest grocery seller in the country. And so that's a way to get some foot traffic and get people in. So Walmart is just a great defensive play.
Interesting. And you mentioned earlier recession. Do you think it's possible that we would fall into a recession, at least in maybe next year?
I think almost we've sort of had a stealth semi-recession now that we're getting all this the BLS data. I think, we not a full recession as in we had negative growth, but I think things were much worse than maybe we initially realized. Now, looking into GDP growth for the next year for 2026, there are definitely some headwinds, obviously, with cutting back on fiscal spending, the tariffs, that type of thing. I don't see it pushing us fully into recession. I think that's a pretty low risk going into 2026. And particularly, I feel better about it when I'm just looking at analyst earnings for the S&P 500. We're currently expecting about 13% profit growth over the next year. And we're seeing very robust numbers just from last quarter as well as we're looking for the next 2 quarters. So I think between Wall Street analysts and how the companies are doing, I think it'd be unlikely that we'd actually fall into recession next year.
Okay. All right. So let's hypothetically, I'm a SlateStone Wealth client. I'm calling you up. I'm like, Erin, give me your favorite picks. You mentioned small and mid caps. You mentioned a couple of the retail names. Are there any that are at the top of your list though that you're saying this is something you really want to pay attention to?
Well, I know earlier we had discussed luxury retail
Hmm.
and on the opposite scale, and the one stock that is doing phenomenally well and is one of the stocks that is in our portfolio is Ralph Lauren. So I
Okay.
have to mention Ralph Lauren
All
because it's
right.
basically the only luxury stock that's really doing well. Um,
Now, why
so
is that?
really on brand marketing. It's one of the few brands that the Chinese still want to buy.
Okay.
Like their sales in China are exceptional compared to pretty much all the other brands. So I think they're very disciplined with their marketing campaigns, more so than some of the other brands. And I also think that just having such a large scale, they obviously have, what we call the affordable luxury brands are built within Ralph Lauren. So they really do have that full scale of whether you're going high end or low end. And again, also a little bit of that 90s trend where they've been really on target with getting the right clothes and hitting the trends for what people want.
And those and the shirts at the U.S. Open for the ball.
Right,
They
exactly.
were
Yeah. I
amazing.
mean, they keep just knocking it out of the ballpark. So again, being very specific about consumer discretionary.
I definitely understand that. Well, that's great. Well, Erin, you always say it all every time you come to buy, hold, sell. I know Toby with this show will probably last another hour if he was here because he'd just be chip chat and whatever. But we're going to close out on all of that, and we will have all these picks as well. Some of these stocks in the description. So for the audience, you would definitely want to take a look and check those out. But Erin, how can everybody reach you? I assume SlateStone.com.
Yeah, slatestones.com. And absolutely, you can reach me anytime. I'd be happy to give a free consultation. We have some great people here. And so it's a really great firm. So happy to talk to anybody.
That's great news. Well, that's super. Well, Erin Gibbs, definitely look her up. She's a chief equity strategist at SlateStone Wealth down in Jupiter, Florida. And I know she'll be there as well as everyone else to help you out with all of your investment needs. So that's great. So Erin, thanks again. And on behalf of Erin Gibbs, I am Todd Schoenberger. Thank you once again to the audience for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.